Point number 5 I want to cover is the legacy benefit. So if you have this plan set up to where you have a mixture of annuity and whole life insurance, with those whole life insurance plans, you're going to have a death benefit as well. So you build up your cash value, that's what you can draw from for retirement income, and then you have the death benefit. And that's going to pay, when you pass away, that's going to pay out to your beneficiaries income tax free. So you're building a legacy, a tax-free legacy that is, using pre-tax dollars. So that's very powerful. And this is one other thing to note. This is one of the only ways to fund life insurance with pre-tax dollars. Almost every single scenario, when you go to fund cash value life insurance, it has to be after-tax dollars. But this is actually a way where you can use pre-tax dollars to fund life insurance and deduct the full life insurance premium. Very powerful. Not a lot of people are aware that this is an option. So keep that in mind. But ultimately, with this, what I wanted to touch on is the legacy component. We can't forget that. It's very powerful. If you pass away prematurely, or even whenever you pass away, your family's going to get the death benefit income tax free from the whole life insurance policy. Very powerful. Point number 6 that I want to cover is just going through a real world example, just giving you an idea of how the numbers would work. Again, it's an example. These numbers are not going to be the same for you, but the point of this example is just to show you, and showcase rather, how this actually works. So let's say, and this is a simplified version of it, let's say you got a 55-year-old business owner earning $900,000 a year in profit. Normally, assuming a 40% tax bracket, normally they'd be paying $360,000 a year in taxes on that $900,000. So what this person is doing differently, instead of just paying the $360,000 in taxes on that, what they're going to do is contribute $300,000 a year from that $900,000 in profit over to one of these plans that we've been talking about. So what that's going to do is instantly lower the taxable income for that business owner by $120,000. Again, that's using approximately 40% in taxes. So you contribute $300,000 to the plan. Now you're paying, or instead of paying $900,000 in taxes, or paying taxes on the full $900,000, now you're only paying taxes on $600,000. So that's just an example there. And for this person too, the example, they're going to fund this for 10 years. And at age 65, based on funding $300,000 a year, that's going to create approximately $16,000 a month in guaranteed retirement income for the rest of their lives. And it's when I say rest of their lives, the money does not run out because it's funded with annuities and whole life insurance. The annuities will never run out of money. You'll get a paycheck for the rest of your life. And the whole life insurance policy is going to continue to grow at a guaranteed interest rate for the rest of your life, as long as the policy is in force. And that's going to be approximately $200,000 a year in guaranteed retirement income. And over the 10 years at that $300,000 funding amount, this business owner would have deducted $3 million for the business and would have saved approximately $1.2 million in taxes. So instead of paying that money over to the IRS, this business owner chose to redirect that money over to this plan and ultimately saved a boatload of money in taxes and created a guaranteed pension plan for themselves. And then lastly, like I touched on, if this person were to pass away prematurely, then the family or the beneficiaries that he or she elected to this plan would get a income tax-free lump sum of money or legacy.